Ladies and gentlemen, thank you for joining us for lunch and the 2022 Economic Outlook Summit afternoon session. Beginning with our keynote presentation, please welcome to the stage Portfolio Strategist with Bank of America, Carlos Mladineo.
Thank you so much. It is truly a pleasure to be with you all today. I flew in from Los Angeles this morning, and I got to tell you, the flight was perfect, not a bump in the sky. The landing was a little hard. I think the plane literally bounced off the ground a couple of times when we got there, but happy to be here. I'm going to start off with some opening comments, and hopefully we'll make this engaging. I know sometimes when you spend all day at a business conference, you know, it takes some stamina to get through the day. I pulled some stats on the state of Utah. I don't know Utah very well. Believe it or not, I was born here. Go Utah. But I didn't get the chance to live here very long. So I went to the website from the government, U.S. government, and I pulled some stats on Utah. And I got to tell you, you guys are rocking, okay? Just a couple of things to look at. Labor force participation, at least the stats that I saw as of 2020, so a couple years old, 68% in Utah versus nationally 62%. Unemployment rate in Utah, again, these stats are a little dated, a couple of years, but you know, for what it's worth, 2.1% unemployment in Utah fairly recently versus 3.7 nationally. Home ownership rates, 70% in Utah versus 66% in the U.S. Median income, $75,000. It's probably a little higher now versus 71 nationally. And finally, median home prices, at least at that time, were lower at $325 versus $350 nationally. So it's like you're checking every box. That's awesome. This is an amazing state. I have vacationed here occasionally in the national parks. And you should all feel proud and lucky to be here. By the way, I mean, I know we've been in a crazy housing market. What would you say is the median home price today, like across Utah? I mean, is it $500,000? Is it less, more? $650, depending on the county and area, of course. How about a lot more than it was just a couple of years ago, right? Now, if you're a homeowner, in some senses, and you're not necessarily looking to trade up, that's like, score. I just got a bunch of home equity. If you're a first-time home buyer, aspiring first-time home buyer, a little more challenging. And those pressures, of course, we've seen throughout the country. You know, one of the trends that started not that long ago that honestly I was fascinated by was this whole concept of I-buying, right? Little I followed by buying. I-buying of real estate. I said, how does that work? You mean computer algorithms are just telling these companies what to buy, what price to pay, sight unseen, no inspection, no walking through the house? And sure enough, that was sort of one of the examples of the excesses that we were sort of going through recently, right? Zillow aggressively moved into this business and of course later had to retrench. Redfin, others, right? Huge institutional investors piling into that market. And of course, that has an impact on affordability, and it certainly has an impact on availability of homes for all of us that are just looking for a place to call home, right? The other factor on housing real quick that I thought, of course, is probably common knowledge to many of us is that you have a huge surge in household formations that's sort of continuing to happen, right? Think of a person in their late 20s, early 30s. Maybe they've been living on their own, but perhaps they've been living with roommates. Perhaps they've been living with mom and dad for some period of time, right? And they finally pull the trigger, get married, and decide to establish themselves in their own home. So all of those things to say that, you know, there was a surge in demand. There was a surge in, you know, from the institutional and from the individual side, and we get to where we are today. Well, from what I can tell, those things are pressures that are starting to alleviate, and obviously we all know why. Interest rate policy changes have been dramatic this year and have been forceful. You know, if you ask yourself the question, what comes next? we can paint a picture, right? But this whole idea that any one person could precisely identify the future sort of through data points like, where will the Fed funds policy rate end up being? Our bank says 5.25%. You may disagree, you may agree, right? How quickly will inflation start to come down by the end of next year? Our bank might forecast, roughly an inflation rate of 5% down from the current levels that we're seeing this year, right? But when you think about economic questions like that, what I would argue is it's not so much the idea of precisely pinpointing a specific fact at a specific point of date in the future. It's more about understanding trends and the implications for businesses. If you could indulge me in just one quick thing, I do want to ask a very simple question here, and the spirit of this is to get to know the audience that's in the room with me today, okay? So if you're willing, it's not an obligation, but if you're willing, I'd just like to throw out a question about the types of businesses that you guys represent. So, is anybody here currently with a company that is publicly traded? The stock is publicly traded. Stand up, just one quick stand. Okay, so we've got a few people that represent companies that are publicly traded. Awesome, thank you so much. Who here is working at a private company that has sort of venture capital or institutional funding on the equity side, right? And that's different than typical privately owned businesses that are often family owned and have been bootstrapped. Who here represents a company that has VC investment, institutional money on the equity side? A few of you out there? Okay. Who comes from my favorite category, which is the bread and butter of America? It's what's made sort of a lot of us so proud to be Americans for so long. Bootstrapped companies, family-owned companies, yes, probably got started with credit cards. Then you moved on to asking friends and family for money. Maybe there might have been an angel investor here or there, right? But basically not a formal institutional long-term process for raising equity capital. Who's here from a company that sounds like that? Okay, awesome. So depending on the kind of company that you work for, you can imagine some of the pressures that we're going through might inform different strategies for a go-forward basis, right? Because I'm not just here to talk about broad economic trends. That can get a little wonky pretty quickly, right? My real goal today is to give you some tangible thoughts on how can I push forward and pursue growth in the right way, in the smart way, given the changing environment we're dealing with. And the answer depends on what kind of company you're working for, frankly. How many of you have been to Disneyland recently, by the way? Raise your hand. In the last year, let's say. Okay. What are we paying to go to Disneyland? Come on, shout it out. How much did you pay? Too much. If you want the fast pass or the genie or whatever it is they call that thing now, I mean, it's going to set you back at least $150, maybe $175 per person. It wasn't that long ago that you could get into Disneyland for a day for less than $100, maybe $75. Probably like roughly 10 years ago. I grew up in California, so it's sort of near and dear to my heart. These are the things that we're dealing with, right? Housing prices have gone through the roof. Recreation has gone through the roof. You might ask yourself, well, how do I make that work, right? Wages are increasing, of course, right? But costs are increasing faster. When we've looked at some of this data, here's what we're observing. A lot of people are fretting right now over the potential or the likelihood, or perhaps, dare I say it, the certainty of a recession, right? Our economics team is forecasting next year's GDP full year, this is an estimate, to be roughly negative 0.5%. And that's off the back of 5.9% positive growth in 2021 and an estimate of roughly 1.8% this year. If you string those 3 years together of GDP growth, by the way, you know what you come up with? 5.9% positive, 1.8% positive, and then about a half a percentage point negative. it kind of equals what GDP growth has been over the last decade and a half, which is between 2 and 3% per year. So that to me doesn't sound like some horrific situation, right? But of course, people that look at publicly traded stocks, which tend to overreact, of course, both on the downside and on the upside to emerging economic data, will tell you this is not good for the market, right? It may not be that positive for capital raising either, et cetera, et cetera, et cetera. But I want to ask you, like, if you put yourself, either if you are the business owner or the CEO of your company, or if you could be one day, or even if you're not going to be, put yourself in that position for a minute. Perhaps your company does 5 or 10 million in revenue. Perhaps you guys do 100 million in revenue. Perhaps you do 1 billion, right? Does that really sound so horrible that GDP growth would be down less than 1%? Like, if you ask yourself logically, the answer is clear. No, that's not a horrible situation, right? So, let's go back to that phrase that we know from that man that most people love who says, I like to be fearful when others are greedy, and I like to be greedy when others are fearful. Think about what we've just seen with valuations, right? There was such a huge influx of cash that people were happy to pay 50 times earnings, 100 times earnings, 200 times earnings, not to mention, of course, all the investments that were made into companies that were burning tens of millions of dollars in cash every year, right? That have zero earnings. That's kind of where we just were. And now we're heading into a period where things are coming down, right? You don't have to look far. You can look at Netflix. You can look at Carvana. You can look at a name that's closer and near and dear to the heart of people in Utah. You can look at Qualtrics, right? A lot of these companies are down 60, 70, almost 80%, right? Does that mean their businesses are falling apart? No. In many cases, are they still growing revenue? Yes. In fact, if you look at the broader market, based on where, if you only looked at the stock market as an indicator, right, and what we've been through this year, down 20, back up to down 10, down 20 again, depending on which index you're looking at, feels awful. And yet if you look at the earnings, what do the earnings tell you? The earnings have grown from last year to this year. The earnings have grown, right? Now, of course, people will say, wait, Carlos. This is about future expectations. Of course it is. The market is a discounting mechanism of trying to predict a future that's unknown. If your question is, what do earnings look like, at least for the largest publicly traded companies in this country next year, it's obviously a debate. But some people, at least the folks in our research team, expect a softening in earnings, right? That shouldn't surprise us. Now let me get back to that comment about what strategy should I pursue depending on what company structure I'm working under. You probably all know that publicly traded companies, there are some huge benefits that come along with being a publicly traded company, right? Access to broad and deep capital markets that can allow you to grow faster and more quickly than would be possible without it. But when you're a publicly traded company, what are the downsides? Come on, let's get some audience participation here. What are the downsides if you're a CEO or CFO of a publicly traded company and you have a real good idea of where you want to go in the future, but you're entering into an environment that's a little challenged? You're locked into short-term earnings, aren't you? And if you don't have a big ownership stake in the company, right, and you want to keep your job and your stock options, and you don't want to see your stock tank in its price, guess what? You have to get obsessive about the next quarter's earnings. What does that mean? You have to sometimes go to extreme levels to manage or eliminate expenses, even at the cost of long-term growth, right? That's how the game is played. That's why the big publicly traded companies hire fast and fire sometimes even faster. And a lot of that news is starting to trickle out. I have a sister that works at Facebook. She was not part of the 10,000 people that no longer work there, thankfully. But is it possible that there could be another wave of 5 or 10,000 that are gone? It sounds like a crazy number, doesn't it? But what was even crazier is that company in the last 2 years hired about 20 or 25,000 employees, right? That's a good example of sort of getting a little bit ahead of yourself and then having to retrench, right? Will they sort of recover and get to a point where they probably need the same number of employees they had when they started this year? Yes. Yes, they will. But they have to manage expenses aggressively now in order to survive. And that's what we're seeing in publicly traded companies. So, you know, to the extent that you have sort of the ability to continue to focus on long-term value-generating projects, you need to do that, right? What does that look like? It could be making the right investments in technology, right? It could be improving the human capital in your business, right? And in many cases, human capital is something that is so underestimated, right? The people that walk in and out the door every single day are often represent sort of the most critical value of any company. And so how can we create an environment for them where they feel secure and where they feel empowered to unleash their own creativity in support of the business? If you're VC funded, institutional funded, it's going to be tough. I'm obviously stating something that's incredibly obvious, right? But that's the truth. It's going to be tough. Why? Because there's not as much capital chasing ever escalating prices and deals. So what are you going to have to focus on? You're going to have to get, if you're still in the cash burn mode, you're going to have to get to profitability, or at least have a reasonable plan that's realistic, that people believe gets you to profitability in the next couple of years at the most. Now, there will be some companies that have backers that see the revenue growth potential being so significant, or that see the total addressable market being so huge that they will continue to fund and pour money into some of those companies. But obviously, it's going to be fewer and fewer, right? So at these companies, you have to pivot. You have to. There was a comment made by someone in a recent article that said a lot of these tech companies sort of lost their focus, right? It's good to dream big, right? We're a country that believes in the American dream, right? We're a country that believes that you can take something, an idea, and then create something that's very, very significant if you have the right capital support, if you have the right human capital support, etc., right? So, but again, if you want to sort of survive what could be a couple of lean years or longer, you're going to have to orient your activities, your focus, and your people, and your technology spend, etc., on things that are going to be able to lead to sort of a faster payoff. Will we eventually move back into a period that allows for more aggressive fundraising at higher valuations? Of course we will. It'll take some time. I don't think we're talking 3 to 6 months, or even 12 months, or even 18 to 24 months. Those things move in longer waves. So what about the person that works at a company that is bootstrapped, family-owned, privately owned, doesn't have institutional investors, right? You guys are in the best position to succeed. Why? Because when you don't have to report your financial results publicly, and when you don't have sort of a board on the private side that's looking at what you're doing and may have very strong opinions that are different than what your strategic vision is, you can be limited, right, to some extent. But privately owned companies, for better or for worse, were those that typically had to get to profitability pretty quickly, otherwise they wouldn't survive as an enterprise. And their growth curves, of course, are significantly slower than what we might see in some of these companies that become unicorns and then some in a period of years. These are companies that are the backbone of our economy, if you think about it, right? At Merrill Lynch, we have the privilege of working with a lot of clients that are on the tail end of what they've built over a period of 5, 10, 15, 20, 25, 30 years. It's incredible to hear these stories, right? It's the everyday American dream coming to life. I just sold my business. It was my heart and soul. I put everything I had into it. There were a lot of years when I didn't take a lot of money out of that business. We were relatively modest in our spend because I plowed every dollar back in, right? Over time, I tried to hire the right people and retain them. We built new factories, facilities. We expanded our geographic reach. We entered markets when others were retrenching, right? And now we have this huge success on our hands. In fact, now we don't know what to do. We've got all this liquidity, and we've handed over control of the company that we love so much to someone else, right? But those stories are awesome. And I know they're all over the country, and certainly there are many people present here in Utah that are living that same story today. So how can we help? How can we help? A couple of things come to mind. If you're in that framework of privately owned, you have the ability to make investments and to take a hit on profitability in the short term if it will lead to long payoffs, right? So what could that look like? Well, it could look like acquiring inventory at a discount from a competitor that's under financial stress, right? It could look like entering a new geography where perhaps, certainly there might be some competition, but where you believe that your offering, whether it's good or service, you have reason to believe that you can outcompete who's already there, right? It could look like hiring that extra set of engineers or tech developers to keep working on a project that you know will be successful in the near future, right? So what am I saying here with this? What I'm saying is sometimes when the clouds start coming, it's easy and normal to feel intimidated, afraid, reticent about over-investing and making a mistake. Nobody knows the companies that you work and run better than you do. But I would just say, this is a time to be optimistic, right? And this is not sort of a Pollyannish, I'm denying the facts, right? We're not denying the fact that there are some pressures that are coming, that borrowing money is more expensive, right? Whether it means to buy a home, whether it means to fund a business, right? But at the same time, you don't want to get so hyper-focused on some of those challenges that you forget that there are still real opportunities that are out there that you can take advantage of. We have folks, obviously, at our company, and there's many others like us, that will provide assistance where needed, right? If you happen to need or are considering bank financing, maybe you've run a profitable company for a long time and haven't relied much on it. And you might say to yourself, well, why would I do that now when it's even more expensive to borrow? Well, the key question is, can you generate value in excess of your cost of borrowing with projects that are smart, that you can execute well on? And if the answer is yes, then you should take a look. We have a team of investment bankers, obviously based here in Utah and in other states, that can certainly help with capital raising activities for those that have the dream of one day becoming a publicly traded company, et cetera, right? We have wealth management advisors, of course, that work on the private client side. But, I don't mean to give you a commercial, but obviously we're proud of the work we do in the state. We've lent over $1 billion to middle market companies here. We have over $100 million roughly lent to small businesses. So, we want to be a partner at the table to assist you in the work that you do there. A couple other things. I know that you guys had an inflation panel earlier this morning, so I'm not going to say too much on that. But I will say this, we are seeing some signs of encouragement, right? The pressure that we felt from gas prices is not as bad, at least not at the extreme levels that we saw recently. Before all this mess, what was the price of gas for regular gas in Utah, roughly, per gallon? What was it? I don't know. How much? $2. Okay. And it's roughly, is it still close to $4 today? It's funny. I come from California and say, wow, $4, that sounds pretty good. Because every single pump that I pull up to says $5.50 or $6. Of course, it's all relative. But I don't think that's your peak value, right? Is $4 down from the highest that you saw? Okay. Housing. Everyone talks about rents getting out of control. It's true. But if you're a homeowner and you refinanced or purchased at 2.5%, 3.5%, guess what? Your housing cost is not going up, is it? Right? What about education? Well, I think that's been a pain point for all of us for a long time. Inflation rates in education and medical care. Do you guys have the same experience that I do sometimes, that you go look at your benefits package and then you see, how much is this going to cost me next year? And it's always like double digits. You say, what's going on here, right? Why is it always so high, the growth in the expense every single year? Some of those things we've lived with for a long time. Maybe we didn't love them, but they weren't in and of themselves creating the environment that we see most recently, right? My message on inflation is really quite simple. The Fed is pulling liquidity out of the system. We know that. We see it in the interest rate policy. And by the way, we see it in their quantitative tightening, where they're letting balance sheet roll off, right? They bought a whole bunch of treasury and mortgage bonds, and that's one of the reasons why the 30-year mortgage is so high. They're pulling liquidity out of the system, but that's the job that they have to do, right? And I believe that when the market is convinced that we've started the process of slaying the inflation problem that we have, things will start to settle into a new normal. Will they go back to how things were before? No. But it'll make it easier to make business decisions, strategic decisions, business investments, et cetera, because you're going to feel like you have more clarity. All right. The war for talent. This is real, isn't it? If you guys have a 2% unemployment rate, I imagine that many or most of you that work at companies are dealing with this issue. And it's not just, sometimes it's reported in the news, the retail frontline workers, right? Like restaurants can't find people to work. In some cases, crazy to think about this, restaurants close because they can't find the workers they need, even though people want to eat there, right? But obviously it's not limited to that. The war for talent is real. Every company has to take it seriously. And you have to ask yourself the question, can I make a longer term investment in this individual or these groups of individuals, right, as I build out teams, that will ultimately lead to significant payoffs in the future? And the answer is, if you hire the right talent and you organize their energy and effort in the right direction, you will succeed. It's a challenge now. Will it get better? It will. If the Fed is successful in their mission to drive, and they'll never say this, right? It's interesting. They'll never say, we want high unemployment. Why? Because it's politically, you can't say that, right? But that's really what they're going for, because right now the wage pressure on inflation is sort of the main driving factor. If they're successful with some of the tools that they have, and if we see that start to crest and come down, I'm not going to say that's sort of the green flag that gets waved to say all systems go, let's go 100 miles an hour into the future. But that should be informative for all of you making decisions that will impact how you take your businesses forward over the next couple of years. Okay, last thought from me. Too much, right? Did you ever go camping when you were a kid, or teenager? Come on, who's gone camping here? You're Utah. I think everybody in this room has gone camping. Okay. I wasn't a huge camper. I did participate in the scouting program growing up, so my dad literally never took me camping. But I went camping through the scouting program. Okay. So don't you remember that there always seemed to be one or maybe more than one individual that couldn't get away from the lighter fluid? Right? I mean, you're supposed to be able to start a fire without lighter fluid, frankly. I don't know that I can do it very well. I just use those Duraflame logs. I love those, right? You light the paper and the rest of it's magic. But there was always someone, or more than one person, that didn't want to just start the fire with lighter fluid. They wanted to keep spraying the bottle in, right? And you would watch that flame sort of start to leap out. and you thought to yourself, at some point, if that flame makes it all the way into that bottle, we're going to have a big problem here, right? So why do I share that story? It's a silly story. I think a lot of us can relate to it, you know? For good or for bad, that's what we just went through. It's so easy to criticize the Fed. They're a sitting target. The fact of the matter is, put yourself in their position, right? Could you do any better? It's up for debate. You have blunt instruments with huge lagged effects, right? They did the best that they could, and they're doing the best that they can now. So my message to you, Utah, is simply this. You have a lot to be proud of. You guys are doing amazing as far as a lot of the metrics that we look at. You've got a highly educated workforce. You've got really good labor productivity and participation. Unemployment is awesome. Unemployment is really strong, you know. You've got a lot of competitive advantages, I would say. And I hope you don't mind. Perhaps you do. I know that a lot of people in California can't stand I call it the land of excesses. And I say that sort of tongue-in-cheek because we have excessive taxes. We have excessive real estate prices. We have excessive plastic surgery. We have a lot of excessive things. And people have started to shift to other places, Idaho, Arizona, Nevada, Utah. If you happen to have a neighbor from California, I hope they're not overly annoying. Not all of us are terrible people. We do have family values in California. And, you know, don't blame it on them if they're just trying to find a place where they can actually have a reasonable life and decent relationships with their neighbors, et cetera, et cetera. So, you know, the final word from Bank of America is we're so grateful to be part of this meeting. Thank you so much for letting us be your sponsor. And my best wishes, my sincere best wishes to each and every one of you. We have tremendous respect for the people that show up each and every day to support business and to lead business. You guys are the heart and soul of this country, and we would not be where we are today as a country without all of you. Thank you so much. Have a great day.